People ask me what keeps me awake at night. It's not the investments, it's the exits, right? And so we try to go into our investments with an eye towards what are the potential exit options. Strategic exits, are bound. But if you look at the model in certain sectors, like in clean tech, right, you don't see the dynamic that you see in pharma. In pharma, if I'm a drug discovery startup, I know that when I pass certain stage gates, one of the big pharma companies will acquire me. That doesn't hold true when you're in the energy space, right? Trying to think specifically about who are coming in. So the construction of the syndicate is quite important. Having strategics that commit more than just a token amount of investments is quite important. Having an eye towards where's the handoff, because venture only takes a startup so far.
Welcome to Forging the Future. 90% of deep tech startups fail due to funding gaps. Breakthrough innovations in climate tech, aerospace, and materials science often struggle to secure funding. The risk is high, but so is the potential to reshape entire industries. Few investors have the patience and vision to take on these challenges. Deep tech is the frontier of progress, but it needs capital. So I'm here today with Paul Sheng, co-founder and managing partner of the Fathom Fund. Thanks for coming to the show.
Yeah, nice to see you again, Chris. Of course, you and I have known each other for quite some time now.
We have. We're both members of Goose Capital.
We are.
We're both out there fighting the good fight, trying to raise capital for venture. And I've been looking forward to this.
Yeah, and after your inauspicious intro, I kind of having second thoughts as to whether or not this was the right career choice.
Yeah. So wait, I didn't know it was going to be such a challenge.
Yeah, exactly.
So tell me a little bit about Fathom Fund. What is that?
Yeah, so we are a deep tech VC based out of Houston, founded about a year ago. So we've been publicly launched for roughly a year. Originally created, when I was in my last career, which was with McKinsey, thinking about what I want to do next and getting back to my technology roots. Actually did a lot of thinking, particularly around this region. As you know, we in Texas, we're the fastest growing economy in the U.S. Many of the megatrends that are, happening around the world, this is kind of ground zero, right? You think about the energy transition, you think about molecules, new materials, you think about the aerospace community, agriculture, and so forth, semiconductors, coming through Austin. And yet, when you look at our ecosystem here, we really don't have a lot of financial VCs, like you say, who have the experience and knowledge as well as the risk appetite to take on these tech-based startups. And so that was kind of the exam problem, if you will, and if I were to think about Houston, we've got quite a mature private equity community. And of course, we've got the big corporates. But in between the financial VC, what we found was, an opportunity there to, create an institution that could be a lasting venture investor here in the city.
Maybe touch on a little bit what it was like to raise a venture fund in Houston.
Yeah, tough.
This is tough overall. I know that. Last couple of years have been really tough.
First of all, the notion of a deep tech fund based in Houston was novel, right? But we didn't come about it out of the blue. Even back in my McKinsey days, McKinsey had supported some work with the Greater Houston Partnership to look at the innovation ecosystem here and indeed more broadly in Texas. And, and you look, whether it's Greater Houston Partnership or a number of other studies, people always have identified, investing as one of the critical gaps, right? And we went around asking the question, well, if this is such a good idea, how come nobody's done this, right? And what are the blind spots that we're running into? So, yeah, we talked to private equity, we've talked to corporates, we've talked to family offices, we've talked to other VCs around the country. We've benchmarked a number of VCs and looked at the aspects that we liked and the aspects that we would change. I mean, we looked at, the Engine, MIT's fund in Boston. We looked at Coke Disruptive, in the middle of the country. We looked at Lux and DCVC on the West Coast. And they're all institutions that we admire very much and we aspire to be, right? And indeed, setting a marker for what would it take to be a top-tier deep tech investor, but based out of Texas. And from that, it kind of set the guidelines of what we wanted to do, the investment thesis and so forth. And then we went around looking for individuals who would take that kind of a risk that resonated with that message. And it was tough because, frankly speaking, Houston is a private equity town. People have a private equity mindset, which is everything is about bricks and mortars, assets, cash flows. To go in and to say, I'm going to invest in a bunch of startups that are pre-revenue. Some of them are just, quote, teams and themes. Some of them are a bit more than that, but a measure of technology risk in areas that they perhaps only have peripheral understanding. I think every family office can give you an example of a biotech investment they made that they got burned on, right? And so it's actually made people relatively technology risk averse. And so that was a tough hurdle. And it took a lot of one-on-one conversations. To be honest, there's a bit of relationship building and trust that occurred. But once we were able to get, one or two anchor investors, there was a bit more comfort, and that led to more, and that led to others, right? So there's a bit of a snowball effect that happens there. And frankly, we were fortunate, right? And very grateful. It was a tough period to raise, and to be able to do what we did in that time frame was very difficult. The other thing, of course, is it's not about me; it's about our team. And so my partner Eric Belke is a very experienced venture capitalist. Former GE Ventures, former head of deep tech for Temasek. So coming in with a very strong track record in this field, and coming in a very strong conviction. And I think the final aspect was the operating model. Not just where do we invest, but how do we invest? And the fact that we would bring the rigor and discipline of a late stage investor to the early stage. We're not here to make a number of small, shallow investments, but to be very targeted, high conviction around where we do invest. So I think those are the kind of factors that convinced our LPs to come on board. So we have, roughly 2/3 of our investors are family offices.
In Houston or abroad? Or
a combination, mostly in the region, but we have a couple of international investors. We have some that are outside the region. We have 3 corporates, and then we have a major research university and that's a very potent mix, because even our family LPs are families who have a very industrial background, which was important to us, right? Because yes, it's great to have capital, but just as importantly, it's great to have the advice and to rely on our LPs also for support in terms of technical talent, in terms of asset base, in terms of relationships.
Yeah, I think that's one of the challenges. Of course, there's many challenges in raising a fund, but finding that persona that actually is interested in what your model is. And so it sounds like what you found was family offices that understood more of the industrial space, or understood a little bit more about deep tech, and then they could understand what you're doing. Is that what happened?
Yeah, correct.
And then also traditionally for a fund one, it can be difficult to get some of those institutional investors in, because what I've seen in my own is like, oh, well, we don't invest in emerging managers, and an emerging manager is often defined as fund 1, fund 2, and fund 3. Like, so they're not going to come in until fund 4, right? Which is probably 10 plus years from now.
But I think the data shows that emerging managers often outperform.
Absolutely, but it doesn't seem to really change their mind. But I'm impressed that you got 3 more institutional investors or corporate investors. So it's more corporate, right?
Yeah.
To come into fund 1. Was that an issue for them at all? Did that topic come up, or they're just like, hey, we're in? Well,
to be honest, it was partly because I have a McKinsey background. Yeah. Some of them were former clients of mine. So there's a bit of trust in knowing, what I was trying to do, what our team was trying to do.
Mm-hmm. Okay, interesting. What makes deep tech and moonshot projects so difficult to fund?
Yeah, all right, that's a bit of a loaded question. What makes deep tech projects difficult to fund? I think one is time frame. So deep tech projects, by the way, deep tech doesn't necessarily mean hardware. It's just, we define it as research-based, high IP moats, difficult to replicate, right?
So it could be hardware or software.
It could be software. In fact, one of the areas we're looking hard at currently is scientific computing, and we're looking at software. We like math and math-based innovation. One of the things is the long gestation period. It takes a long time to prove out a concept. It takes a long time to bring something from the lab to a field pilot. It takes even longer from a field pilot up to a commercial scale, right? You could have a great innovation around green cement or green steel, just to pick something off the top of my head. And after 5 or 10 years, you're making kilograms. Well, commercial customers won't talk to you unless you're making tons per day. Right. Or so it's generations and generations of scale up that's required, and therefore generations of capital that are required. One, I think the second that makes it tough is a lot of the topics are esoteric. It's not a consumer-based marketplace. And so to have someone that can go deep and understand that. So our team, are highly technical. Most of us are PhDs. We go deep into quantum computing, into propulsion systems, into green chemistry, into material science. You name it.
Do you have any time machine projects? Because I could use that one.
No time machine projects yet. But we have a small team, but we rely on a large bench of advisors. That come in on a project by project basis, and they are university professors, they're retired executives, they're serial entrepreneurs, so people who we've worked with over the years in one capacity or another that we bring in. So the ability to bring in fact, in the last couple of deals we've done, one model that's worked well for us is to bring in 2 experts. One that's an academic that can test the theory and the science behind it, and one that's a retired executive who can test the go-to-market aspect of it. And we find that triangulation, oftentimes they don't agree either. And of course, we're the tiebreaker in that. But bringing in different perspectives and triangulating from as many points of view as possible, as quickly as possible, is kind of the magic formula for us.
At SoftTech, we don't just follow the trends, we set them. As the founder and CEO, I've built a team that excels in delivering cutting-edge solutions in software, hardware, and IoT. From concept to completion, we're the partner that turns your tech dreams into reality. SoftTech, where innovation starts. Which is also the advantage of investing in a fund like yours, because trying to evaluate that tech, even in our companies, which is more, say, traditional technology, if I want to call it that, not the deep tech, a investor, an angel, or even a VC, can find it difficult to evaluate those businesses because they don't have that engineering background and they don't have that, subject matter expertise, network that they can draw on. So you're much better off putting the money into a fund that can evaluate that and de-risk the investment.
Absolutely. Yeah. Well as a fund that can systematically source deals, right? As well. If you are an angel investor, usually you get your deal flow from, somebody's neighbor or a friend of a friend, referred to you. And therefore the quality is somewhat patchy. You really have to have the volume of input in order to be able to select, the best opportunities. And that's where, the good part of our year, this past year, has been reputation building, right, and networking. What I found, unlike private equity, which is sometimes can be overtly competitive. Venture capital is a highly collaborative game. So your ability to network, your ability to source from each other, to syndicate. Every deal is a syndicate, right? And once you have the reputation, being able to use that to your advantage to source into deals as well as bring others in. There's a level of trust that happens. And we've been fortunate to be able to build some bridges with some quite strong fellow investors. A couple of big corporates have come in with us on our deals because of the quality of the technical work that we do, which we're quite proud of. We're starting to network with the big VCs on the Bay Area, in Boston, and so forth, which is helpful. One of the things we find, our calling card being here, is if you're a deep tech startup in Boston or in San Francisco, it might be fine to start there, but as you scale up, the manufacturing happens here, the supply chain happens here, the customer base is here, and in some cases, the exit opportunities are here. And so invariably, having an investor that can sit over the shoulder in the region is a strength.
So how do they know, for example, that these are quality deals? I mean, because you're very early in the process of selecting these companies, and deep takes a long time. Does it take longer? I mean, a lot of venture funds have like a 10-year horizon, although some would argue that it's stretched to 12 to 14 years now. But in deep tech, is it longer?
It can be longer. Especially these days, I mean, people ask me what keeps me awake at night. It's not the investments, it's the exits, right? And so we try to go into our investments with an eye towards what are the potential exit options. A few years ago, it was SPACs, right? And they were prevalent, and then that kind of waned. IPO market has waned. Hopefully, it comes back in the near future. Strategic exits, are bound. But if you look at the model in certain sectors, like in clean tech, right, you don't see the dynamic that you see in pharma. In pharma, if I'm a drug discovery startup, I know that when I pass certain stage gates, one of the big pharma companies will acquire me. That doesn't hold true when you're in the energy space, right? So there's there's a bit of a question mark in terms of happens. So trying to think specifically about who are coming in. So the construction of the syndicate is quite important. Having strategics that commit more than just a token amount of investments is quite important. Having an eye towards where's the handoff, because venture only takes a startup so far.
Well, I guess that really leads into the question of how do you evaluate the potential in these higher risk deep tech startups, which is really doing a lot of innovation, for say, like when you're trying to say, well, we think that if they do build what they're going to build here, this is where it's going to get to, and this is how they're going to exit.
Sure.
Right? So how do you figure that out?
Well, it starts obviously with the IP, right? Is it truly distinctive? We like to look at startups that are creating, I'll oversimplify, but markets of one, right? We try to shy as much as possible away from startups that produce a commodity. If I'm doing something that's going to be 10% cheaper, 20% cheaper, somebody will catch up, right?
So you're with Peter Thiel and 0 to 1, basically, right?
Something like that. So I think that's one aspect of it. Second is the team. Having entrepreneurs who have done that before is important. Having entrepreneurs who know how to pivot. The quality of the team is quite important to us. The right combination of youthful energy and the gray-haired experience is quite important for us. I think having a technology that has a platform capability. So we're looking for things that have application in 2 or 3 different markets, not, instead of something that's beholden to one specific value chain. And then, the commercial pipeline, right? At least understanding how does it get to commerciality We do a lot of customer interviews or potential customer interviews, even at an early stage, right?
So like if they build this and it's real, would you be a customer?
Right. So for instance, we just closed an investment in direct lithium extraction, and we actually interviewed a half a dozen lithium producers, right? And, we also benchmark against other technologies. Sometimes we pick a theme, and we're quite proactive about themes, but we don't know which one's the winning horse. And so you have to diligence several of them in order to understand the advantage and disadvantage of the one versus another.
I know how important staying informed is for innovation and growth. The Forging the Future newsletter brings you the best in tech trends, startup advice, and industry insights. Join our community and forge your future with us. Subscribe now. I was going to ask you for some examples. I know you've done 5 investments. I don't know if you can talk about any of them, but just like an example of what a deep tech investment actually.
Yeah, happy to. So the latest one we closed is an Australian startup called Electrolith. So they are a direct lithium extraction a startup, a spin out of Monash University in Australia. Of course, if you look at that space, there are 50 some odd startups doing lithium extraction, one sense or another. This is a new class of technology based on electrodialysis. So we, benchmark that versus the sorbent technologies. We benchmark them against several other startups that we knew of, not only on a technology feasibility standpoint, but also on a techno-economic. We actually, did cost teardowns. We looked at Chinese technologies and how low they could go. We looked at the competitive pressure. And we've talked to 5 lithium producers and to look at, what's the feasibility, particularly, the characteristics of brine, whether it's in South America in the Triangle, whether it's in the Smackover or the Paradox Basin, what's the potential for scale up, et cetera, et cetera. You get the idea of how deep you have to go into the analysis to make an investment. And by the way, this was an opportunity that we came to us from Rio Tinto. And so having, one of the world's leading brine producers fully behind this. So we came in, Marathon came in, Chevron came in. It was led by Main Sequence, which is the leading deep tech investor in Australia. So that was a nice syndicate that all came together. So that's an example where it all comes together nicely, right?
I'm starting to hear the McKinsey part of your experience when you're doing those deep dives.
Well,
and the research.
But you got to be careful because you could go too far. Like I said, if you do a deep enough, you'll find fault with anything.
That's true.
There's another one which is Xscape Photonics, right? Which is silicon on photonics. So this one's in semiconductors. Xscape is a startup, is spin out of Columbia University. And it's in the chip-to-chip communications space. So the thesis is, as GPU capacity gets greater and bandwidth gets, computing demand gets larger, where does the bottleneck going to shift? And, one thesis is at some point, copper will run out of bandwidth. And so what happens then? And so Xscape has created a laser, a comb laser, and a fabric that allows, optical communication between chips.
At the board level?
At a chip-to-chip level.
Chip-to-chip.
Yeah, at a GPU level.
Mm-hmm.
And the party trick is this comb laser can transmit light at, 8, 16, 32, 64 frequencies simultaneously. So instead of 1 bit, it's transmitting 16, 32 bits. So you're getting, an order of magnitude more in terms of bandwidth at 10% of the energy. Which is pretty breakthrough.
Very cool.
But it took us several months to build conviction around that. Again, we, customer interviews, we brought in engineers, we looked at the market, we interviewed some of the potential end customers for this, and we created and there was a syndicate where, it was led, essentially NVIDIA came in, Cisco came in, we came in. And so again, a syndicate that included strategics as well as financial VCs.
Interesting that you're getting all of those very well-known firms and investors to come in and be along for the ride.
Yeah, like I said, with an eye towards, how does a startup move towards an eventual exit?
Because all of those investors are interested in the technology.
They're customers.
Mhm.
Yeah, potentially.
Yeah. So what role does Houston play in fostering frontier tech innovation?
I think Houston has a number of unique advantages, right? When you go and talk to a startup out of MIT or out of Stanford, what they would say is, we can start our company here, but as we grow, we quickly grow out of headroom there. And the scale up opportunities are in Texas, right? And in Houston. We are, the energy capital of the world, and arguably we are the molecule capital of the world. And so, the talent base is here, the business friendly environments here, customer base is here, supply chain is here. And so there are a lot of natural advantages to scaling up. Now, Houston is also an innovation hub. We're not a Silicon Valley, we're not a Boston yet, so it's still to come. But we are seeing lots of green shoots, right? And not just in energy, although there's a lot of that happening. But also, you look at robotics, you look at aerospace. There's lots of good stuff happening.
Tech, et cetera.
Yeah, exactly. The life sciences. There are lots of good stuff happening here at an entrepreneurial level, and with places like the ION, Greentown Labs, and so forth. We're quickly getting, the nucleus or the nuclei of this innovation is starting to take shape, right? So it's something where I can see the piece of the puzzle. They're not all formed yet, but many of the pieces are there. It's logical to think that in a few years, in the not too distant future, we will lead. I think Bill Gates in the last CERAWeek said, Houston is the Silicon Valley of energy, right? And to a lot of extent, that's true.
I know he just has a book out called Source Code. I need to get it.
Yeah, me too.
I think it's biographical. So, Paul, what's your long-term vision for Fathom Fund?
Well, Chris, from a very selfish perspective, is I want to build an institution that outlasts me. That's why, like I said, I want to be the oldest guy in the room. I think, if we look back 10 years from now, 15 years from now, there'll be Fathom Fund, but there'll be a cluster of Fathom Funds in Houston, right? And that's a good thing for us. I think the venture community should be as mature as the private equity community is here. I think, we should be on the map with a Silicon Valley, with a Boston, as the ecosystem, the molecule capital of the world, as well as the energy capital of the world. I see us, fostering a whole generation of entrepreneurs, and not just the young kids coming out of college, but the mid-careers, right, who are not afraid to move out of their roles in the energy companies and the chemical companies in the region and try something that's a little riskier, in the knowledge that there is a safety net here, right? There is a support network here that's here to help them be successful. And I see a set of unicorns, right? I think the biggest litmus test will be whether or not Houston can create a cadre of unicorns.
You touched on the mid-career professional and their willingness to leave a job like Exxon or Mobil or Chevron or something like that and take that red pill like you did with McKinsey, right? So, but I think many aren't really ready to do that. I always viewed that step as not like jumping off a cliff because I felt I could always go back. Like it's more of a safety net than like a cliff. Like I'm pretty sure if you went like, hey, McKinsey, I think I might want to come back or something like that, you can go get a job in the industry, right? With your experience and pedigree. So, but I still see some hesitation where they don't want to leave the cushy job at some of these companies to venture off into a startup.
Well, again, I think the analogy here, if we were to fast forward, 10 or 15 years from now, would be, again, what you see in the pharma industry, right? You see a free flow of people who go from the big pharmas to the venture capital world to the startup world, and they change jobs and move interchangeably, and they're accepted interchangeably. if you could define an energy ecosystem, right, or a chemistry ecosystem, that's the same. That people can move from being an investor to being a founder to being, on the corporate side. If that was a free flow of people, and the best way to carry ideas is to carry people, right? I think that would help us get over kind of the over the edge, or get the activation energy to a certain level where it could be a self-reinforcing loop here in the region. We have a ways to go there, but again, it's something where if you look, you see many of the pieces of the puzzle there.
Yeah, I think once you show them that it works and that it can happen.
Yeah.
And
well, it works in other industries.
Mm-hmm.
We just need a little bit of time for it to work in ours. Right?
Yeah, exactly. Well, this has been super interesting, Paul. Definitely want to learn more about some of your deep tech investments. And so I'm sure we'll talk more later. But in the meantime, I have some socks for you.
Oh, great.
Cats with money. So, hey, some cats.
Cats with money.
Yeah. So I don't know if you're a cat guy, but I know you're a money guy. So I know who doesn't love cats, right?
Exactly. Well, thanks a lot.
Yeah,
I'll wear them with pride.
Absolutely. Thanks for coming on the show.